Hello and welcome. Thank you for joining us for today's webinar, Cash is King, but Sometimes the Emperor Has No Clothes, a presentation on selected distortions of reported cash flows. My name is Judith Conley, your CFA South Florida Society Administrator. This afternoon's webinar will run for approximately 40 minutes with the remaining time devoted to Q&A. This webinar will end promptly at 1 p.m., so any unanswered questions will be addressed by email. Directly after this webinar, you will receive a 30-second survey. CFA South Florida leadership are always working to deliver quality content, and your feedback will help to enhance member value. Before we get started, here are some upcoming events you won't want to miss. On Tuesday, March 16th, please join us for an insightful career development panel discussing how you can cultivate your digital presence to compete in today's professional market. Our career panel will be followed by Florida District Dialogue with an address from Senator Rick Scott on elder investor protection. This event will take place on Thursday, March 25th. In April and May, we have socially distanced networking opportunities scheduled throughout Broward and Palm Beach counties. Registration will be limited, so please visit our website for more details. Now I have the pleasure to welcome Dr. Jacek Welz with us directly from Poland. Dr. Welz is an assistant professor at Wrocław University of Economics and a lecturer in corporate finance at SRH Berlin University of Applied Sciences. He owns a PhD in econometrics as well as a diploma in London Chamber of Commerce and Industry. Dr. Welz has worked as an independent consultant, head of corporate finance department at Dexus Partners, and consulting manager at PKF Polska. In his academic work, he specializes in financial accounting quality, having published more than 30 research papers and presented his findings worldwide. In November of last year, he published his new book titled Reading Between the Lines of Corporate Financial Reports. Thank you, Dr. Welz, for being with us today.
Okay, thank you, Judith, and welcome everybody. This is my pleasure to have an opportunity to offer you my webinar related to some selected distortions of reported corporate cash flows. So please just give me a few seconds. I will share my screen. Okay, I hope it works now. Okay, so this is one of the common myths in corporate finance and in the financial statement analysis as well is that cash is king, while reported accounting profit is an accountant's opinion. Cash is king, in a sense that one of the myths or one of the flaws in thinking about the financial reporting is that while balance sheet and income statement may be even deliberately manipulated, the cash flows, reported cash flows, are resistant to such manipulations. But this is not the case. Actually, there are two groups of factors that may cause distortions of reported cash flows, and those groups of factors may be classified as objective weaknesses of accounting regulations, which sometimes make reported cash flows compliant with accounting standards, but not necessarily compliant with an economic substance of a given circumstance. Accounting is just a simplification of the business reality, economic reality, sometimes very complex. So accounting standards are not perfect, and sometimes it also brings about some distortions of reported cash flows. But the second group of factors are deliberate accounting manipulations, fraudulent accounting practices, which may distort or ruin the credibility not only of income statement and balance sheet, but also cash flow statement as well. And today on this webinar, I would like to very briefly, due to time limitation, go through selected problems, which are listed here on the first slide, and all of them will be illustrated with some real life examples. Let's start with the first problem, first listed here because it corresponds to one of the recent cases of accounting fraud committed by a large company here in Europe. This is Wirecard AG, the German company, so-called European Enron. Here in Europe, the term European Enron was invented by some commentators for the case of Wirecard, and that's the company which went bankrupt. They filed for bankruptcy on the last summer, in July 2020, and that was this spectacular bankruptcy was preceded by multi-year accounting fraud, in which the company that finally, just before its bankruptcy, reported the alleged cash balances on its consolidated balance sheet, the alleged cash balances amounting to as much as over €3 billion. As it turned out, as much as €1.9 billion of that pool has turned out to be fake, non-existent. So this was just the fake cash balances, fabricated cash balances. And if in such a case, if cash balances themselves are fabricated, then of course the cash flow statement cannot be considered reliable as well. This is because of the double booking entry principle in accounting, that overstated, in the Wirecard's case, overstated cash flows corresponded to overstated reported revenues, inflated revenues, or manipulated revenues. The historically typical way in which revenues are inflated deliberately is in correspondence with receivable accounts. There are just invoices which are not collected, are never collected, because they are invoices, falsified sales, resulting in fabricated invoices, and of course the receivable accounts from such invoices can never be collected. But in such cases, when the cash balances, when the revenues are inflated deliberately in correspondence with receivable accounts, then this is something which is immediately visible in the cash flow statement, on the balance sheet too, but in the cash flow statement as well. But Wirecard went one step forward, because not only they issued fabricated invoices, but they also pretended that the cash from such sales have been collected. So because of this, no any warning signal in the cash flow statement, reported cash flow statement of the company could have been found. Please note in the data here, as we can see, in those 3 fiscal years, 2016, 17, 18, as well as in the first half of 2018 and 2019, the company reported growing revenues. Those revenues drove operating earnings upwards, but those operating earnings were to a large, at least seem to a large extent, to be fully covered by operating cash flows. In almost all of those periods, actually reported operating cash flows exceeded reported operating earnings, which by many financial statement users was treated as kind of like the crude proof of the high quality of the reported accounting earnings. But if we now take into account that as much as almost €2 billion cumulatively, €2 billion of cash cumulatively through several years have been fake, it also means that probably that amount of operating cash flows, that's also the amount by which the company's reported operating cash flows have been overstated. So as we can see, if we compare that total amount of €1.9 billion of overstated cash balances to the cumulative operating cash flows reported for 2016, 17, 18, then it turns out that the company could have probably not generated any positive operating cash flows at all in none of those periods. And that was obviously one of the reasons for its collapse. So this is very important. I think this is something kind of like like the accounting, fraudulent accounting innovation, because so far even the classical textbooks on the evaluation of earnings quality, they tended to treat operating cash flows as a good simple proxy for or the good simple metric or check of the reliability of reported earnings. But this is no longer the case, because now, apart from Wirecard, we also recently had some cases in the UK, companies like Redcentric and Patisserie Valerie and several others. So this is no longer, that's the conclusion from this case, no longer the case for some small obscure companies on developing markets where fabricated cash balances are sometimes uncovered. But recently, this is the accounting problem which started to affect also reliability of financial statements reported by public companies listed on developed markets like Germany or UK. And okay, another problem which is related to operating aspects, no longer any fraudulent or fraud-driven distortions, but distortions of reported operating cash flows brought about by some totally legitimate companies' activities aimed at increasing its financial liquidity. And that's the example of Claire's stores, which exemplifies a very common spurious improvements in operating cash flows of shrinking businesses. The term spurious here does not mean any, does not correspond to any deliberate manipulation, but it means that the company which starts facing financial liquidity strains, it is not uncommon that at that very point of time, the company's managers start prioritizing financial liquidity, the boost to financial liquidity, rather than reported profitability. So this is not uncommon that many companies, also my research found it in many other cases, many companies that that are about to lose financial liquidity, they started doing kind of like fire sale liquidations of non-cash current assets. So they intensify sales of receivable accounts to factoring institutions, for instance. Also, they do a fire sales of inventories. If this is the company where inventory is a significant asset, like in retail or wholesale or some manufacturing businesses. And that was exactly the case in Claire's stores. Please note that in the fiscal year, the last fiscal year before the company filed for a bankruptcy, the company improved its reported operating cash flows, which grew from negative minus 21.2 1 year earlier to positive plus $8 million in the fiscal year ended January 28, 2017. But that boost to operating cash flows came mostly from positive contribution by almost 20 plus 20 million from the change in inventories. And as the company explained in its annual report, that was the liquidation of excess inventories accumulated through several preceding periods. Like, you know, this is the chain of retail points, retail stores. So the problem was that they accumulated excess inventories, obsolete inventories of not very fashionable, very popular, very attractive goods. So to get rid of them, they had to aggressively cut the prices to very discounted levels. And that exactly translated into a deepening reported operating losses, which, however, were matched by seemingly improving operating cash flows from negative amounts to positive ones. But that was one of boost from liquidation of inventory, which did not reflect the sustainable long-term improvement in inventory management efficiency. So that's something which, of course, the company had to do. So no any reason to act to accuse its managers for any poor behavior at that time. But at the same time, from the pure perspective of the financial statement analysis, like ratio analysis, that boost to operating cash flows was purely one of effect of this fire sale liquidation of the company's inventories. And this is not uncommon for many. This is also the result of the research of one of my former students, that many companies which are just about to file for bankruptcy, in those very moments, just before the company defaults, the companies often report positive and rising, allegedly improving operating cash flows, but the devil sits in details. The structure of those cash flows very often suggests that this is not a real improvement in the company's operating efficiency, but rather some aggressive liquidations of excessive liquidable or cashable, marketable current assets like inventories or receivable accounts. Okay, another more nuanced distortion, which now is the category of distortions which is caused neither by accounting fraudulent activities nor by operating activities of the company. This is related to some objective weaknesses of accounting regulations, and this distortion is very important because this is something which in my opinion, my personal opinion, something which is not very something which many financial statement users are not familiarized with, not even aware of. This relates to the accounting standards related to the financial statement consolidation. So how to consolidate the financial results of the parent company, reporting entity, and its subsidiaries. And this will be illustrated by the French company. Probably for you, this is something, the name of this company tells you nothing. This is Rallier, the French company listed on Paris Stock Exchange, which filed for a bankruptcy in May 2019. And it also had several subsidiaries, but its main subsidiary on the first level beneath the parent company in the group structure was Casino Group. Casino Group itself had some subsidiaries, some companies operating in Colombia and some other countries, and all of them were distributors of general distributors of FMCG goods, mostly supermarkets, kind of like Walmart or Tesco or Carrefour, this kind of business. But now please note in the structure. First, the group structure. On this very simple chart beneath the table, we can see that Rallier held slightly more than half of the equity interest in its main subsidiary Casino Group. That was 51.1% at the end of fiscal year 2017 and 52.1% in the end of 2018. So more or less about 50% plus of the share in the Casino Group's equity. And of course, Casino Group was correctly treated as a subsidiary. But the problem is that in such group structures, this is not uncommon, that while liquid financial assets, and also generated cash flows, operating cash flows, they are generated in those operating subsidiaries, so to speak, on the lower level. At the same time, very often, a lot of consolidated indebtedness, consolidated liabilities is attributable to the parent company, because this is not uncommon that the parent company is the one who, for instance, issues corporate bonds, and then after obtaining some proceeds from some borrowings, those proceeds then are distributed or disseminated among the group members, other subsidiaries, etc., by the company. But then, if we take the consolidated financial report, it may happen that what we see there is the consolidated cash flows, which actually do not reflect the real cash flows attributable to the parent company. Please note, now in the table we have 5 consecutive years of fiscal years of data, 2014 through 2018. And let's start with the upper part. In the upper part, we have consolidated cash flows of Rallier. So this is cash flows of Rallier itself, its standalone cash flows, plus 100% of the amounts of cash flows reported by all of its subsidiaries, adjusted for intra-group transactions, if any. But what we can see here is that in all those 5 years, the company reported positive operating cash flows. They were contracting, in fact, but they stood positive in all those years. But then, as we can see in the lower part of the table, which shows the consolidated cash flows of Casino Group, the main subsidiary of Rallie. Just to remind, this is the subsidiary in which Rallie held slightly more than 50% of shares. And we can see now, when we compare operating cash flows of both those 2 line items marked by a yellow font, they are almost the same, which means that actually the parent company did not generate any significant operating cash flows. Virtually all of its operating cash flows were generated by its subsidiary, Casino Group, in which, however, they held only slightly more than 52% of shares. But this means that if those operating cash flows and accumulated cash balances of the subsidiary are to be used by the parent, for instance, to serve its own debts, to repay its own borrowings, for instance, then the significant distortion appears, because only 52.1%, as at the end of 2018, of those operating cash flows of the subsidiary, which are fully included in consolidated cash flows of the parent, only slightly more than half of those operating cash flows are actually available for the parent for its own purposes. That's very, very significant problem in groups of companies which have several layers of subsidiaries. Please note that it may happen, and this is the case of one of the IT companies listed on the Warsaw Stock Exchange here in Poland, which is the 6th largest company in Europe. The parent company holds 51% shares in its subsidiary on the first level. Then subsidiary holds 51% equity share on the lower level of its own subsidiary, which in turn holds 51% in the 4th level of the subsidiaries. And despite this, the 100% of the amounts of operating cash flows, as well as other assets, revenues, etc., of all those subsidiaries are added to the respective numbers of the parent on consolidation. So if we now take into account that the parent has 51% in the subsidiary, which in turn holds 51% in lower subsidiary, which again holds 51% in yet lower subsidiary, then at the end of the day, from the amount of any cash flows generated by the subsidiary on this lowest level in the group structure, only somewhat more than 15%, can get up to the top, to the parent. Despite that, 100% of the amount is reported as consolidated cash flow. So this is very important to be aware that in case of the group structures with significant non-controlling interests or significant subsidiaries of the parent, which are non-wholly owned by the parent, and in which case parent company holds relatively low share in equity, like 50% or even more, even less sometimes. This is very important to be aware that what is reported on the consolidated cash flow statement may be significantly distorted by lack of any adjustments for those non-controlling interests in the equity of subsidiaries. Okay, another distortion. This is capitalized intangible assets. This problem will be illustrated by the example of Starbreeze AB. That was the Swedish video game studio, video game maker and developer, which filed for a bankruptcy in late 2018. So what we can see here are selected data extracted from the company's balance sheet and reported cash flow statement for the 3 consecutive years prior to the company's default. And what we could see is that its total assets, the amounts here are in millions of Swedish crowns. that the Swedish crown SEK was is the functional currency of companies operating in Sweden. Sweden is not part of Eurozone. So the amounts are in Swedish crowns, and we could see the significant increase on the asset side of the company's balance sheet, increase in total assets, which was to a large extent attributable to an increase in the carrying amount of the asset labeled as capitalized expenditure for games and technology development. What it means, this means that the amounts that the company was spending on its actually R&D works, research and development works related to its games and related technologies, instead of being expensed as incurred, so reported as expenses as incurred, the same way as, for instance, advertisement expenditures are expensed as incurred, such expenditures under IFRS, International Financial Reporting Standards, they were treated as investments in intangible assets. So when they spent, like for instance, between the end of 2016 and 2017, they spent more than 300 million of Swedish crowns on such works, on new games and developing old games. This 340 million landed on the company's balance sheet under this item, capitalized expenditure for games, which is just kind of intangible assets, instead of being expensed in the income statement. That was totally consistent with the IFRS. But it does not mean that if something is compliant with accounting standard, it's not always compliant with economic reality, because the very that was a relatively small video game studio, so they did not work on, say, portfolio of 100 new games, from which 2 or 3 will be successful and will earn for themselves as well for those others who are not successfully commercialized. That was a typical case of the relatively small video game studio, which by definition meant a high concentration of their R&D expenditures on selected titles, limited number of titles. And because this is kind of like the industry which is sometimes labeled as hit or miss business. You create new video game and it may be a hit or just a complete miss, so that you can even recover costs incurred for developing this. If this is the case, then if it turns out now that actually that turned out here because the company had to file for bankruptcy, if it turns out that of that amount that landed, that accumulated amount of expenditures on intangible asset that landed on that has been capitalized on the company's balance sheet, if most of this is not recoverable because the games are not good enough to be successfully commercialized, then it also means that operating cash flows reported by the company were overstated as well. Why? Because if those expenditures on new games, if they are expensed as incurred, they reduce operating earnings. If they reduce operating earnings, this also means that they reduce reported operating cash flows. In contrast, if the company treats its expenditures on broadly defined R&D, including video games or similar intangible assets, if they are capitalized on the balance sheet, they are treated as intangible assets, then at the same time, from the reported cash flow statement perspective, they are treated as investment, that they are treated as part of investing cash flows. And that's exactly what was the case in the Starbreeze. As we can see in the 2015 and 2016, the company reported slightly positive, but at least positive operating cash flows. But then below, in the investing section of its cash flow statement, we could see that those investing cash flows were deeply negative, which was mostly attributable to huge amounts reported here with minus as investment in capitalized expenditure for games and technology development costs. This means that if more conservative approach could have been applied by the company, more conservative, meaning expensing those expenditures as incurred, rather than capitalizing them on the balance sheet, then not only assets would be leaner, so to speak, but also the amounts reported by the company as investing cash outflows would reduce operating cash flows. So if we see that was like almost 300 million crowns in those 2 years, 2015, 2016, if that was reported as operating cash outflows, then those very operating cash flows would look completely different as compared to what the company reported. That there would be no any plus in those 2 years, but there would be deeply negative amounts reported here. So that's very important because actually the company turned out to be unsuccessful, to fail in its commercialization of those games that they spent so much money on. And well, yeah, it turned out that those operating cash flows reported for prior years had no any touch with the economic reality, even though they were entirely consistent with international financial reporting standards. Okay, another distortion. This is customer financing schemes. And this will be illustrated by the case of Volkswagen Group. That's an interesting case because Volkswagen Group restated its reported cash flow statement for the fiscal year 2008. As we remember, 2008 was a very special year in the global economy and in the car industry particularly. That was the outbreak of global financial crisis. And now please note, first, please, let's look at the data. Let's start. Those two columns report the annual report cash flows for a single year, for 2008. But they come from two different annual reports. What we see in this middle column, this is cash flows for 2008 that I extracted from the Volkswagen Group annual report for that very 2008. And we could see that they reported operating cash flows of almost 11 billion, 10.8 billion, matched against investing cash outflows amounting to over minus 19 billion. 1 year later, if we still just at the moment focus on the totals, total operating cash flows and total investing cash flows without paying any attention yet into details, 1 year later, in the annual report for 2009, of course, the company reported in this report the cash flows for 2009, but also for the preceding year, 2008. And in that very report for 2009, we could see that for the previous year, 2008, now the company reported operating cash flows much lower than what it reported for the same period in its annual report published 1 year earlier. Because now operating cash flows, they were still positive, but only plus 2.7 billion as compared to 10.8 billion as reported before. Why did it happen? Because the company reclassified two items which previously, not only two items, but it reclassified two cash drainers, so to speak, from investing cash flows to operating ones. As we can see, in 2008, the company treated its change in financial services receivables, as well as change in leasing and rental assets as part of its investing cash outflows. And those two items, those two line items of the cash flow statement, they correspond to the company's policy toward customer financing. As we know, if we want to buy the car, we can go to the dealership point and we do not have to always pay 100% immediately. This is not uncommon that even for individual customers, private persons, not to mention in B2B sales by Volkswagen Group to other corporations, there may be schemes like you pay 50% now and the remaining 50% 1 year later, 1 year from now. So the substance of this is typical trade receivable account. They gave us deferred payment term for 1 year or even more for significant part of the price that we agreed to pay for the good that we purchased. But from the legal form, not economic substance, but from the legal form perspective, the companies like Volkswagen Group, they arrange it differently. We go to the dealership point and we buy the car for cash 100% for cash, but half of this cash is ours, but the remaining 50% is a loan granted to us by Volkswagen Bank. Almost all car manufacturers, they have their own, or banks, or financial segments of their operations. So we are actually borrowing from Volkswagen Bank, and from this borrowing, we fund we co-fund the purchase of our car. That's one way. The second way, instead of buying the car, we can just lease it. So the legal ownership is left on the company of the seller, because this is not a sale transaction. This is just like a rental, right? But if the company like Volkswagen produces, say, 1 million cars that instead of being sold, they are leased out to its users, then actually this is, from the economic substance perspective, this is the operating cash outflow to produce those cars instead of investing one. And because of this, the company changed its classification of such outflows by transferring those amounts of over 8 million, minus 8 million, that it treated as investing cash flows, to treat it as part of operating cash flows 1 year later. They did not explain it, probably, and no any accounting standard, no any IFRS related to this change at that time. I know because I checked it. So perhaps the auditors told them to do so, or some pressure maybe from shareholders, supervisory board, or I don't know. But the conclusion is that sometimes arranging some transactions, dressing some transactions, some events which actually are part of pure core business operations, dressing them in the way that allows or enables some interpreting them as investing cash outflows, it's also one of the possible distortions that may boost reported operating cash flows to much above what is reflected or what corresponds to the economic reality. And that was exactly the case of Volkswagen Group in its fiscal year 2008. Okay, another distortion, this is business combinations. And this will be illustrated by the example of the British company Conviviality PLC. That was a retailer and wholesaler of soft drinks, including alcoholic drinks. The company which grew both organically as well as by some takeovers, typically quite small takeovers. The company was just swallowing relatively small family-owned distributors, etc., until they finalized the major takeover, very significant one from their perspective, because that was much bigger target company than those which they swallowed before. And in the fiscal year ended May 1, 2016, Conviviality, the company listed on at that time at London Stock Exchange, acquired the controlling stand in the company named Matthew Clark. That's the name of the company that they acquired. And the problem is that in such huge business combinations, even if it is an acquisition of the non-operating company, like bankrupt company, whose single asset, even theoretically, hypothetically, whose single asset is, for instance, inventory. I did several evaluations of Polish previously state-owned companies for privatization purposes several years ago. And it was not uncommon that those companies, because of being bankrupt, they were acquired by some Western European companies that just took an opportunity to buy some new subsidiaries. But those subsidiaries actually had no any ongoing business operations. This was just a combination of no longer related assets, very often old inventories, some properties, etc., etc. And theoretically, we can imagine company A, which is the acquirer, buying 100% shares in company B, its new subsidiary. And let's imagine now that the only assets of this new subsidiary are inventories valued at 100 million. That's the worth, that's the fair value of those inventories. And if subsidiary does not, this new subsidiary in this hypothetical case, does not run any business operations because, for instance, it is bankrupt recently, then effectively from the acquirer perspective, this is the purchase of inventories by 100. So even though from legal perspective, we buy 100% of equity interest because we just buy shares in this new subsidiary, from the economic substance perspective, this is nothing more and nothing less than just purchase of inventories for 100. But despite that, an increase in working capital from all business combinations like this is treated as investing cash outflows. As I explained here in this frame, under most accounting standards, at least those that I know, equity investments, purchase of equity shares, minority stakes or majority controlling stakes, whatever, equity investments are treated as investing cash outflows, regardless of a composition of net assets acquired on such business combinations. As a result, reported consolidated operating cash flows are stripped out from any takeover-driven increases, often huge, in working capital. And conviviality is, I think, a good illustration of this, because as we can see in this first line here, this is the company's reported consolidated operating cash flows for this fiscal year, for that very fiscal year, when they acquired Matthew Clark. And the reported cash flows allegedly stood at a positive amount of plus 21.8 millions of British pounds. But then what we could see in two places in the company's primary financial statement, we could see changes in working capital. The first was change in working capital as reported in the company's consolidated cash flow statement. And that was minus 1.8. But then when we, instead of taking this reported change in working capital in cash flow statement, if instead we calculate on our own change in the working capital, increase in inventories, increase in receivables, minus increase in operating payables, from the balance sheet, from the consolidated balance sheet, end of the fiscal year versus end of the previous fiscal year, then what we could see was that despite reporting in operating cash flows minus 1.848, the balance sheet year-end to year-end, the balance sheet change of working capital, consolidated working capital, was minus 31,768. And this gap, calculated here, and amounting to 29.9 million of British pounds, was attributable to the Matthew Clark takeover, because that was exactly the amount of working capital, mostly inventories, held by this troubled new subsidiary. So effectively, the purchase of Matthew Clark was to a large extent acquisition of inventories, plus some receivables and other assets, but mostly inventories, amounting to almost 30 million British pounds, which was, from the cash flow statement perspective, was treated as outflow of cash, reported as investing cash outflow, because the full amount paid for this takeover was reported as investing cash outflow. So when we now adjust the reported convivialities, reported consolidated operating cash flows from this reported amount of plus 21.8, when we adjust it downwards for a difference between change in working capital between cash flow statement and balance sheet, then the adjusted cash flows were minus 8.1, so completely different picture. So actually the company was burning cash on operations instead of generating positive operating cash flows as reported on its cash flow statement. Okay, and final example is something which is quite recent. This would be based on IFRS, but only recently one of my US friends told me that the similar change of accounting standard was done in US and the US GAAP. I didn't know it before. Recently, I was informed about that. That was change of treating of operating lease. Right? There are new standards for operating lease, under which operating lease obligations are treated as on-balance sheet assets. No longer operating leases are off-balance sheet assets and off-balance sheet obligations. And the same change was done under IFRS. So no longer old International Accounting Standard 17 is applied. Now this is IFRS 16, which capitalizes all lease and rental obligations on the balance sheet. And the thing is that the problem is that IFRS 16, I don't know about US GAAP in that issue, but IFRS allowed the companies to adopt it only prospectively. And this is the textbook-like distortion caused by some such oversimplifications of adoption of the way in which new standards are adopted. This is Norwegian Shuttle, the airline, Norway-based airline, which filed for bankruptcy in November 2020, so quite recently. And these are its operating cash flows and financing cash flows extracted from its annual report for 2019. What you could see there is that in the single annual report for 2019, operating cash flows looked like going up from less than half billion of Norwegian crowns, an okay million, up to 3.0 billion. But that was entirely attributable to the change of accounting standard from IAS 17 to IFRS 16, because IFRS did not require from the company restating in its previous amounts to the new standard, as if those data reported for the previous year were based on the same standard as for the most recent one. And then you can see in the if we go down through the company's cash flow statement, in its financing section, you would see principal repayments of lease liabilities IFRS 16, and this is minus 3.9 billion. And nothing like this happened before, because until 2018, such outflows on principal repayments of lease liabilities, and the company uses aircraft, which is mostly leased, they were part of operating cash outflows, but now they are included in financing cash outflows. So if we adjust it, then we could see that comparable operating cash flows were not +3, but instead they were +3 minus 3.9. So actually that would be minus 900. So the operating cash flows on a comparable basis went down from almost 500,000 to minus 1 billion almost, instead of going upwards as reported on a completely uncomparable basis. So this is also very important to be aware that also kind of like, in my opinion, weird way in which accounting standards are adopted is sometimes also the reason for the cost for distortions of reported cash flows. And that's it for today. On the last slide, you can see my email address. Before I switch to the chat to check your questions, I will have the time only until 1. So I will try to do my best to answer some questions. Those which will be unanswered, please do not hesitate to contact me via email. So please just send me any questions which you already asked on chat, which I will not have enough time to answer, but also feel free to contact me for any other questions if you have. So I will stop sharing, and please let me to open the chat. No question. Okay, let me go to. No questions on this. Have IFRS or GAAP made any changes that would prevent any of these situations from reoccurring? About US GAAP, I don't know, because I'm not specialist in US GAAP. About IFRS, I don't think so. I'm not a fan of IFRS. I'm not a fan of how they are adopted, and I am not a fan of how inconsistent individual IFRS are, because sometimes they are actually contradicting to each other. So to my knowledge, there is absolutely no I have an impression that there is no any awareness even from the International Financial Standards Board, headquartered in London, to work on mitigating the effects, distorting effects of such of those accounting standards which are applied so far. So I'm not very optimistic about it. So this is something which corroborates the importance of reading between the lines instead of just trusting blindly the numbers reported by the companies. What is the role responsibility of the auditors? Do they incur any liability in any of these scenarios? Theoretically, they do. Theoretically, they do, but in practice, it depends on the individual jurisdiction. So, for instance, in some countries which are less developed, like Poland, it's a middle-income country, developing country, but the investors' protection or stock market regulations and supervision is generally very poor. 2 years ago, I would say that this is rather poor. Now I can say that this is very poor, because there was a spectacular, on the local level, spectacular collapse of the company, kind of like Polish Enron. We call this Polish Enron, whose name was Get Back. And that was accompanied by the massive accounting fraud. And despite this, they received the unqualified audit opinions from Deloitte, and many people lost a lot of money, and absolutely nothing happened to the auditors. So I am skeptical about the real responsibility of auditors on developing markets, Poland, South Africa, Brazil, Russia, etc., etc. On more developed markets, we will see. There is the huge discussion about the Ernst & Young EY role in the Wirecard case. Perhaps you know this a little. That was the case when the EY actually overlooked quite very striking red flags, and even some whistleblowers suggested them that you should dig deeper into this and this and this. And now there's a discussion. We will see. Theoretically, there is a responsibility, but how it develops, we will see. So I cannot provide any detailed answer now. Okay, there's another question. Do you have any specific methodology for identifying common distortions? In case of cash flow statement, this is just reading the annual report diligently, including narratives. Because, for instance, sometimes you can see this immediately on the face of the cash flow statement. Like, for instance, in the Starbreeze case. Starbreeze is this example of this Swedish video game studio. We could see a separate line item, expenditures on development of new games. Very clear, understandable. And anyone who went through the cash flow statement of the company, who understand the possible distortions, then he or she could immediately identify the huge expenditure which the company treated consistently and in compliance with IFRS, but not necessarily with economic substance, which they treated as investing cash outflows. But in some other cases, the same or similar expenditure may be hidden behind more obscure title, like purchases of fixed assets, including intangibles, for instance. And then it pays to read the entire financial statement of the company, including particularly the note related to the narrative note on company's accounting policy, because this is not uncommon to find some information about we classify this as this, so then we can conclude where some expenditures or some items, some transactions, how they are treated by the company, and how possibly distorting impact such transactions, such treatment may have. So there's not any kind of like box ticking approach, but just careful reading. The same applies to non-controlling interest. On the cash flow statement, there's absolutely no any line item which shows you non-controlling interest. Please note that in the income statement, when we start from the very top, like revenues, to the very bottom line, net earnings, only that very bottom line is broken down into net earnings attributable to the parent versus attributable to non-controlling interest. But at least there is some information, limited but some. In balance sheet, too, no assets, no breakdown on assets, individual asset classes into assets belonging to the company or attributable to the parents and to the non-controlling interests. But at least in the equity, shareholders' equity must be broken down into equity attributable to the parent versus non-controlling interest. in contrast, in cash flow statement, no any mentioning of non-controlling interest is done. So again, reading the entire report, including the structure of equity links between individual companies within a group, like this, for instance, like this 51% in company in subsidiary A, and then another 51 in subsidiary B, such reading may give you the suggestion that some possible distortions may be there, and it's good to at least be aware of them, even if we do not have enough data to make quantitative adjustments. And the final question is, did any of these firms delay reporting prior to the inconsistencies appearing? Are delays in reporting a warning signal? Yes, of course, but in this case, I think there was no any delay. In those cases that I presented, I think there were no any delays. And of course, the delay is always a strong warning signal. Anytime I'm seeing, even as a stock investor here on Polish market, when I see a delay, I treat it as a very, very significant warning signal. This is either, of course, it also depends on how transparently the company explains this. But if this is something like that, they inform that they did not get auditor's opinion yet because we are discussing something with auditors, then behind this poetry, I assume that probably there's some struggle with the auditor, which itself is a warning signal. So of course, delayed reporting is always a warning signal. And many in the US, I investigated not in the form of the academic research, but I investigated a lot of SEC's enforcement announcements after US Securities and Exchange Commission announced some accounting fraud and penalty on the company, etc. Then I went backwards through the given companies' SEC filings, and in many of such cases, I found that the detection of the very detection of the fraud was preceded by a delayed filing of the mandatory report. So that's always very, very strong warning signal. Okay, so thank you so much. If you still have, because I have to finish soon in 2 minutes, if you still have any questions or suggestions, please feel free to contact me via email. The slides from my webinar, from my today's webinar, I asked Judith to make them available to you. So probably she will share them with you. And feel free to contact me. I will always do my best to reply promptly and to be helpful if I can. Thank you very much.
Thank you, Dr. Betts, for joining us today and for that wonderful presentation.
Okay, so thank you so much. So I'm wishing all of you a safe and healthy rest of the week, and take care in those challenging times. And I do hope to meet all of you again soon. Thank you. Bye.
Bye-bye. Thank you, everyone, for joining us today. Please stay connected with CFA South Florida on social media to learn more about upcoming professional development and networking opportunities.